It's easy to treat cash flow forecasting as a one-off task, but that instinct may be costing you money. The real question isn't whether to forecast, it's when and how often. A cash flow forecast does one thing. It shows whether more cash is coming in than going out over a given period, so you can spot a shortfall before it arrives. The British Business Bank describes it as anticipating financial difficulties ahead of time, so you can act before the problem hits. But here's what most advice skips. The cadence, meaning how often you update it, is itself a decision. Get it wrong in either direction and the forecast stops protecting you. Too infrequent and you miss the warning. Too rigid and you can mistake a tidy spreadsheet for actual financial control. So think of it as 3 gears. Your job is to be in the right one for your current situation. Weekly, when cash is tight, the business is changing fast, or your reserves have dropped to a level that warrants close watching. A new hire, a new market, rapid growth, or a recent revenue dip are all signals to shift into weekly. At this stage, a month is too long to wait before seeing the picture. Monthly for most stable SMEs. And NCVO guidance recommends updating monthly and forecasting a rolling 12 months ahead for small to medium organizations not in immediate financial difficulty. That rhythm keeps the picture current without overwhelming the business. So if your income is reasonably predictable and your reserves are adequate, monthly should be your default. And quarterly only when revenue is genuinely stable, reserves are healthy, and you're in a steady operating phase with no major changes on the horizon. Most businesses don't stay in this gear for long, and that's fine. It's a reward for stability, not a permanent setting. So the practical test is to ask yourself whether anything material has changed in your income, costs, or business model in the last 30 days. If the answer is yes, well then shift up a gear. If things have been predictable for several months, you may be able to shift down. Match the cadence to the actual volatility, not just to habit. So beyond this regular cadence, certain events should trigger an immediate forecast review, regardless of where you are in the schedule. Things like applying for funding or a loan. Lenders will ask for a forecast, and more importantly, you need to know whether the numbers actually support the ask before you walk in. Perhaps you're planning an expansion, a new hire, or a significant new cost. As PwC notes, accurate cash flow projections are what tell you whether you can actually afford the move you are considering. Any unexpected drop in revenue, a large customer paying late, or a cost spike you didn't plan for aren't reasons to panic. They are reasons to update the model immediately so you can respond rather than react. So the rule is simple. The trigger matters more than the calendar. If something significant changes, don't wait for the next scheduled review. There is, of course, always one honest caveat. A well-maintained forecast reduces surprises. It does not eliminate risk. Forecasts are projections built on assumptions, and those assumptions can be wrong. Customer payments slip, markets shift, costs spike without warning. The risk of a fixed schedule is that it can breed complacency. The spreadsheet looks clean, so everything feels under control, even when the underlying assumptions are quietly going stale. So update the inputs, not just the dates. A forecast is only as useful as the assumptions inside it. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.